Today I'm going to talk about what I'm going to do with my money in times like this. It does seem like a pretty sian time lately, doesn't it? Interest rates are falling, bank accounts are cutting rates, President Trump is going crazy with his tariffs, and the stock market is entirely red. Even PM Wong has to come out to tell us that things are not looking good. Is it time to panic and everything? Well, no. And in fact, I've been waiting for this for some time now. So I'm going to talk about what I'm going to do with my money when markets are like this. Now, please remember, I'm no longer a financial advisor representative as of early 2025. So I'm just a guy holding a fork, sharing what I'm going to do with my own money. And this is not financial advice. Now remember to subscribe to the Telegram so you can get updates on earning more from things like your credit cards and savings accounts. In a video last year, I described the way I handle my money, and they can be broadly categorized into three pots: my emergency funds, my short-term funds, and my medium to long-term funds. The first pot, as the name suggests, will be for emergency purposes. The second pot will be for funds I'll need over the next 5 years or so. And the final pot are for funds 5 years and beyond. So some updates on this, and I'll start with the emergency funds and medium to long-term funds because these two pots are the simplest to deal with. Now, emergency funds I've settled long ago. For the past few years, I've been putting emergency funds into high-yield savings accounts. And in mid and late 2024 last year, I placed $20,000 into June 2024 SSB and $60,000 into September 2024 SSB. And I also told my Telegram and YouTube that I was going to do it. Someone at that time complained that my video was posted only one day before SSB closed for that month. Now, firstly, it was 2 days. And secondly, if you really want timely updates, you should subscribe to my Telegram and turn notifications on. Anyway, this is $80,000 in SSB, and based on my spending habits, I feel like this could last at least 2 to even 3 years, depending on how frugal I am. And this also includes mortgage because I also have my CPF OA savings to help with that. To me, having sufficient emergency savings is like having a good boat. In normal times when things are rosy, having little floaty thingies are already enough for you to stay afloat. But when strong tides come in, you want a sturdy flotation device that you can count on for a while. Maybe like the giant ass door Rose was on. Now, even PM Wong says that it is quite uncertain how the current situation would play out over the next few months or even years. So having a good buffer is definitely important, especially if you have recently quit your job cause you are sian of it. But when I know that I have my immediate needs settled for the next 2 to 3 years, my mortgage is taken care of in the event things get really bad, I can breathe better, sleep better, and I think I will be in a better position to make better financial decisions. And this includes things beyond investment decisions too, because it allows a person to properly think through things like career options and other life goals. I've left my full-time job for about 6 weeks now, and I must say that the mind space it has freed up and the contentment I have are things that money can't buy. But what money can buy is me having a sizable buffer such that I can have the security and confidence to leave a role that I wasn't happy with. Yeah, I guess I still owe you guys the video on why I left my full-time job, so stay subscribed for updates. Like I've said before, Singapore has massive reserves and a rainy day fund, and I'm a modern citizen, or I try to be, so I learned from our government having a good amount of reserves in case anything happens is very important to me. So while most people say keep 6 months, 12 months, or even 3 months of expenses as buffer funds, I personally feel a lot more comfortable with a bigger buffer. At least I know if I'm super frugal and I hunker down for winter, my reserves can possibly even outlast Donald Trump. Unless he gets a third term lah. The next easy thing to talk about is the long-term pot. Now, CPF obviously comes into play here, and even though I've been a full-time employee for only the past 2.5 years or so, and my tuition business previously, I also opted to have CPF contributions as an employee on the payroll. So I've accumulated some amount in my CPF over time. I talk about it in my video, so you can go there to see if you want to. And I've also voluntarily topped up my CPF SA in recent years for tax savings, and it's in that video as well, so check that out if you want more details. But the gist of it is that I see my CPF SA as being equivalent to bonds, and now that I'm a bit older, I don't mind having a bit more in my CPF to get more CPF life payout when I become of age. Also, towards the end of each year, I evaluate how much tax I have to pay, and contributing to CPF SA under the retirement sum topping up scheme is a good way for me to reduce my tax obligations above my SRS contributions. Talking about SRS, that's also part of my long-term pot. I've been contributing to my SRS for about 5 years now, and I think it's an arrangement that I'm very happy with. There are 2 major advantages to SRS. First, the most obvious is that it immediately reduces my tax obligation for the year, and if your income tax bracket is 11.5%, that's like upfront 11.5% returns. What other tool can give you that? 2, since the funds are meant for retirement after 62 years old, it's a lot easier emotionally to just invest all of it into equities and leave it alone for the long term. Since I shouldn't touch the funds until I'm at least 62, which is more than 2 decades later, the short-term volatility shouldn't be an issue at all. Also, once I put money inside my SRS, the interest is pathetic, 0.05% per annum. So it's completely unacceptable for me to leave any SRS funds idling, and I will immediately invest it, which is really what you should do instead of timing the market. Lastly, every month I invest a fixed amount to avoid timing the market. I've said this before, and I think it's worth repeating that for most working adults, my belief is that the key to building up an investment portfolio is to make it as automatic as possible. Rain or shine, tariff or no tariff, President Trump, Biden, or Obama, as long as we have any surplus income, we should be putting it to work for the long term. Crisis after crisis, the stock market goes up and goes down, but eventually trends upwards given enough time. So if you have enough time on your side, you should just invest in a globally diversified fund and let growth compound over time. There's a reason why I don't talk about investments often. It is because it should be as boring as watching paint dry. I was on a radio program once, and off the air, the host complained that my advice was too boring, to which I also asked her what kind of advice she would get if she asked a doctor, what's the key to good health. It's all going to be the same things, right? You drink lots of water, you eat your veggies, you get enough sleep. Good habits are often boring. Okay, now that we have gotten the boring things out of the way, I feel like it is time to be a little bit more excited by what is happening lately. And that moves my focus to the short-term pot 2. For my 3 pots, my expectation on returns corresponds to the time horizon I have. The emergency funds have to be in very safe and highly liquid instruments, which is why I mostly use SSB for this, and it gives me more than 3% per annum returns, which is more than decent. My third pot is mostly in equities to grow for the long term, with CPF as a bond equivalent of sorts. For the second pot, the short-term funds, I have been using high-yield savings accounts and savings promos, which have been giving 4, 5, or even 6.8% per annum in recent years. It's very hard to argue with risk-free 6.8% per annum returns, and that's what I've been chasing for the past few years. But as we know now, right, rates have come down quite a bit, and even 4% per annum is pretty hard to get. In my previous video covering the UOB 1 nerf, I said I was most probably going to go for the UOB year-mark promo, which can still bring up UOB's 1 total yield to about 4% per annum for $150,000 balance. Now, 4% per annum is not terrible, but it is pretty unexciting. Well, President Trump's tariffs are really timely because markets are now on discount. Now again, this is not financial advice, but I'm sharing that I've started shifting part of my pot 2 funds into long-term investments instead. I still keep enough funds for near-term needs, but any excess is now dry powder for me to enter the market when things are cheaper. This works because, remember, I have a good amount in my emergency funds that I can fall back on, and despite quitting my job, I still have income coming in for the foreseeable future to feed into pot 2 and 3. So of course, please don't follow, especially since your circumstances can be very different from me. But in my case, it's not often we get the chance to invest at lower prices. Now, I don't believe anyone can consistently time the market, but when you see market drawdowns of 10 to 15%, there's already a very decent entry point. Will it drop more? Maybe. And if it does, I'll just buy more. I'm not trying to catch the bottom. I'm just trying to buy good stuff when it's on sale. That's why I keep my pot 2 flexible. Pot 1 can stretch to cover 2 to 3 years in the short term, while pot 2 can buy things for pot 3 at discounted prices. When savings yields were great, I took advantage of them, and now that yields are falling and markets are softening, it's time to switch gears. I've done this before in 2022. I bought in May, June, September 2022, probably not at the bottom, but still at discounted prices. I've also bought in February 2022. Okay, this one is quite far from the bottom, but hey, I bought something, and these are all now green despite the recent market downturn. So it's very likely that I'll start deploying funds into the market, and in fact, I've already put in $25,000 on Friday night in a globally diversified fund. I know some people might say it's a bit premature and markets can still drop more, but hey, it is fine. I'm just dipping my toe in the water, and if the markets continue to fall, which I actually hope for, I will continue to buy. I also understand myself better, and it is psychologically easier for me to put in tranches of money rather than to wait until things are really terrible before putting in all my funds. Again, I don't think I have to perfectly catch the bottom. I just need to buy things at a discount. There's a chance that Trump could change his mind next week or next month and say, oh, we have struck a deal, declare victory, and then, removes most of the tariff and markets rebound. I mean, this is the guy who banned TikTok and now claimed to be the savior, right? The dude is a master solver of problems he created. So this whole thing could be a nothing burger and blow over, very soon. Of course, there's always the risk that a downturn could last longer and even become more serious, right? China has responded and EU will probably respond and Trump may follow up with even more extreme measures. Now, I'm prepared for this situation as well, and in fact, I'm hoping for it. And I'm quite well diversified. I'm not putting all my eggs in one basket. In the worst case scenario, I still have my emergency fund to cover my short-term needs, so I'm not forced to sell my investments prematurely to cover expenses. If markets stay depressed or go down further, I'll continue to deploy capital gradually, taking advantage of the lower prices to add to my portfolio. If it takes longer than expected for markets to recover, I'll keep my focus on building my port 3 with a steady contribution as I've been doing already, knowing that eventually market will bounce back as it has over the decades. Now, please invest at your own comfort, risk tolerance, and time horizon. I personally don't believe in stock picking, so I'm buying a globally diversified fund. As for what app or platform to use, I'll put a few referral links in the description box. I obviously earn some money when you sign up, but that really keeps me making more content, so thanks for your support. Okay, to me, I think it is very important to have funds earmarked for different purposes so you can have more clarity and comfort in doing things like investing when things look terrible. Hopefully, you can develop your own system, and if you do have your thoughts on the recent market downturn, please share with us in the comments below. Now, this is obviously an evolving situation, and I've only covered the very zoom out view of how I manage my money. So if you want something more specific and you want to follow my journey, right, stay subscribed to Telegram for updates. And if you're wondering how much is required for retirement, I did a little bit of calculation, so I'll see you in this video.